Gentlemen, I'm gonna ask you both to take a little bit of a trust fall with me today, okay? Because this isn't as hard hitting. It isn't a concrete topic. It's more a philosophical topic. As I combed, the news clippings over the last couple of days, racking my brain trying to figure out, what should we talk about this week? And I realized over the last couple of weeks, it's actually become harder and harder to come up with what I would think is an interesting topic of discussion that would warrant time on this amazing network. And what I realized today is that is because of one thing and one thing only. It's because of the rate of change is slowing. And I thought about this in a post-COVID world in the last 30-ish months. There's been massive, not just change. I think generally human beings and traders are good with change. But the rate of change that we experience in the first 15 months to the upside, in the last 15 months to the downside, everything you can measure in rate of change, monetary policy, yields, economic growth, inflation, all the asset prices, your home, all of these things are effectively measured in rate of change. And we're, as humans and traders, we're decent at adjusting for change. The best of us are really good at dealing with change and predicting change or creating change. But I think the rate of change that everybody collectively has had to deal with in the last 30 months is something off of the Richter scale. And I wonder, as we head into 2023, whether you're bullish or bearish or whatever, I tend to believe, and the markets are tending to, it looks like pricing, that rate of change is going to be the biggest change of 2023. Like the idea that we're going to see massive shifts in monetary policy, that's probably not true. Massive volatility in interest rates, there might be some changes and inflation might be stickier, but we're not going to see from 0 to 5, from the floor to 5% in 2023. That's highly unlikely. And any changes on a percentage basis are going to be minimal. Asset prices, same thing. Same thing with inflation. If it's sticky or not, the likelihood that you see these massive changes, I think, is it's diminished. So one, I wonder, do you believe that the world going forward is really about adjusting to a smaller rate of change, getting back to a world where rates of change are more normalized? And if so, what does that mean for traders and for entrepreneurs and companies as they adjust to that new world? One, do you believe the premise? Are you awake?
No,
Do you like the premise?
I'm listening to you. I'm not so sure.
You're talking about momentum, aren't you? Really?
No,
Rate of change
I don't think
is
so.
momentum.
I don't think so. I think he's talking about rate of change, and I've had a similar discussion a long time ago with Dylan on Truth or Skepticism, and we talked about rate of change. We basically talked about kind of like gamma in the market, like. Mm-hmm. And
in gamma in life, really, in everything.
Yeah.
It's in everything.
And I don't know that I subscribe to the idea that the rate of change, you think it's going to speed up. No. I think we've just experienced massive amounts of rate of change. Right.
I think the rate of change in monetary policy and inflation and economic growth and asset prices, I think that rate I think that rate of change in 2023, I think we're going to adjust to a lower rate of change in all of these things.
Here's the thing. I don't think it's possible for the rate of change ever to go back to being the more the world changes, the rate of change is always going to keep up the same pace. We're never going to go backwards. It's crazy to me to think that anything is ever going to go back to, quote, the way it was as far as how fast things move and how fast things change. So like for me, the amount of information and the amount of money, let's call money, forget information, the amount of money that's chasing returns is not going to contract, it's going to expand. And as more people find their way to financial markets, the rate of change is always going to increase. It's never going to decrease. I don't see how it can, because what you're getting is you may have significantly more efficiency, So you're not going to have necessarily less efficient markets, but the rate of change, the way things happen, the speed at which they move, it's going to be lightning fast. Like we might go from a CEO now being safe for, a CEO being safe for 2 years to a CEO being safe for 2 quarters. We might go from an interest rate drift higher to from an interest rate drift lower to an interest rate drift higher, and flip the cards over, 3 or 6 months where it used to take years. I don't believe that you can ever go backwards, ever. In fact, I would challenge you to find one time, as long as you've been around in this industry, in the last, let's call it 15 years or so, I challenge you to find one time where the rate of change has contracted. Now you can find times where we've had contracting volatility, but you can't find things. You're talking about the rate of change is a much broader, much more general picture, and you cannot find a time. He was
talking more about interest rates being steady, not moving as much. I think that was
no.
The way.
I think he's.
Well, that's part of it, Tony. It's
that's what he mentioned.
I think all of these things are on a percentage basis how much they'll change over a period of time. So And to your point, Tony, like we just saw a massive shift in monetary policy. We saw a massive shift in interest rates. That led to massive shifts in asset prices. It will lead to and has led to massive changes in positioning, CapEx, all of this stuff in the real economy, employment, adding jobs, all that stuff. But I guess my point is, I believe in positive drift, but it's an interesting point of view from your perspective, because you guys effectively, once the expectation for the rate of change in asset prices reaches what you believe is unsustainable, once the level of uncertainty or the prediction of the marketplace for these massive rate of changes in asset prices, once it reaches this upper bound as you see it, you sell that. So in other words,
it doesn't matter which side of the market we're on. You're exactly right. We don't care.
But I'm not saying this isn't an inherently bullish or bearish statement. What I am saying is that the change in all of these things, like political, social, our health, the way we've stayed inside, we completely went to nothing, to the way we went from zero staying inside to going out, this massive reopening. Like we've gone in these gigantic leaps from off the floor to 5%, from staying at home to a functioning economy, from zero COVID to potentially reopening China, from geopolitical peace to being, seeing major geopolitical conflict. I am not saying it's inherently bullish or bearish into 2023, but I do think these massive, you sort of said it on Sunday, you threw everything you could at this market. I sort of believe that about life and about the economy, about society, about geopolitical relations. You've had massive stability in a pre-COVID world when you measure it against the post-COVID world. And I think the only mistake in my mind, what I'm trying not to do, is to project. It was a mistake in 2020 to project that amount of consumption, that amount of economic growth into the future. In 2022, it may be a mistake to project this amount of bearish sort of positioning into the next year. I think it could be also a mistake to project these gigantic leaps in rate of change that we've seen as a society and as traders in the last 30 months. I think that as you go forward in time, I think it's a mistake to project out these same leaps of rate of change, because we're not going to go from 5 to 10%. It's unlikely we go from 5 to 10% in.
That's not the point.
What do you mean?
That's you're cherry picking one example. Of course, interest rates are not. You had the magnitude of the move in 2022 in interest rates, in the dollar, in the stock market, in different places. That was extraordinary. You're not going to see those things year to year. It's statistically impossible. But that has nothing to do with the rate of change. You're cherry picking a couple of things. That doesn't mean anything to me. The beautiful thing about the rate of change is it's a much bigger. The rate of change is something that you in in a growing economy and in a true free market, the rate of change can never go backwards. The only place it goes backwards is where time stands still and nothing ever moves. So, and that could be either in a dictatorship or it could be someplace that has no economy other than like tourism, for example. And the rest of the world, especially where there's competition, the rate of change has to always go up. It has to always be faster. Otherwise, the whole system collapses. So it doesn't matter. Yeah, you're not going to see another year where interest rates go up.
That's why you say you don't believe in deflation, isn't it?
Well, hold on. You're not going to see another year, I agree, where you're going to see the move like you saw in the bond market in 2023. However, in 2023, you could see a crazy move in gold or silver. You could see, a crazy move in some other commodity. Maybe it be copper. I don't know. Maybe it be, who knows? Could be live hogs. I don't really give a crap. It could be soybeans. My point is, just because they rotate what's moving, you can't look at that as that's not the issue. The concept of rate of change means how fast do we do things and how fast do things move compared to the speed at which they used to move. And I think that's something that can never go backwards, and you're only going to see a faster and faster as technology continues to get better, and as we bring more people and more money and more speculation into the marketplace, the rate of change is only going to go up because people are all watching the same movie. They're going to be trying to outguess what happens next.
You accidentally just made the case for structural inflation, but I don't want to go there. What does that mean for businesses then in 2023? Like how do you think about dealing with change in 2023 from an entrepreneurial perspective?
It means you can't sit still. It means the companies that are really happy with what they're doing are dead. And the companies that are willing to take risk and willing to try new things are the companies that are going to be most successful when the market decides to turn around and reward them. Right now, if you have a bear market and people are selling everything, there's nothing you can do. It doesn't matter who you are. It doesn't matter what you do. You're going to get your stock's going to get whacked. Your company's going to, you're going to have some difficult things. But when things turn around, everybody is going to gravitate towards those companies that show the most potential, that are the most innovative. And those are the ones that are going to be really hard to sell. And everybody's going to flee all the crap and go to the fastest growing stuff like they always do. At the end of the kind of rainbow type thing, the most successful companies will be the ones that can change the fastest. I mean, and you've seen it. I mean, Apple's a perfect example. Amazon is a perfect example. These are massive companies that were able to perform change at extraordinary rates that smaller companies couldn't do anything with. And I see that pace continuing all over.
Is there a price extreme that exists in the marketplace right now from your point of view? No. There were massive price extremes for a long period of time. You've seen since effectively October through November a normalization of a lot of price extremes with perhaps the exception of energy companies, but you might argue that energy companies at only 5% of the S&P structurally over a longer period of time, that is actually normalizing to be, Did it make sense for energy companies to only be 2.5% of the S&P? Perhaps not. Perhaps you had massive underinvestment there. Do you see any price extremes, either of you, in the marketplace as on December 6th going into the end of the year?
Much less than we've seen the entire year. So the things that were crazy price extremes most of the year, which were bonds, high beta stocks, and the U.S. dollar, all those price extremes have been normalized a little bit. The 10-point rally in the bonds, the 5 to 7% rally in sell off in the dollar, and the stabilization of most of the high beta stocks here. And the final extreme was probably China and the 50% rally in some of these Chinese stocks. I think that all those price extremes have been somewhat normalized and somewhat commoditized. So I don't think you have the same price extremes. I think some of the energy stocks are still at a price extreme, but for the most part, I don't think you have a lot of extreme right now in price that doesn't have anything to do with the speed of change.
Tony walks around with big bills. I'm not really a currency guy, but I've seen when Tony whips out his wallet, there's no small bills in there. He only
Men don't
carries.
carry wallets. They just keep their money in their front pocket.
You a money clip guy?
No money clips. Just wrap it around your credit card. Go ahead. What do you got?
Still a rubber band guy. Interesting. All right. So he only keeps big bills. You got $100. You can't ask for change. Where do you put the $100? Do you put it in the U.S.? Do you put it in Europe? Do you put it in China? Or do you put it in quote unquote emerging markets? What do you do with $100 in 2023?
Well, if I could have answered that question last month and knowing what happened, I would have said the Dow, which I never would have said, right? I mean, So, well, I think I'm a little bit with Tom on this one. I think the stocks that have led us, the Microsofts, the Teslas of the world, are not the ones that will move us forward. And maybe not next year, but the years to come. So I think you have to find the next thing, and it might be that digital asset type thing that everybody freaking hates. So if I was looking for something that's going to give me a big boost in my small return, small money that I have, I'd probably be looking for that outlier move that's gotten really beaten up as of late. It would not.
Tony
be
puts $100 on Coinbase. That's what I'm gonna say.
Yeah, something like that. Yeah.
Well, first of all, if all you have is the $100,
Yep, you can't split it. Where are you going with the money?
Yeah, if all you have is $100, you cannot go to any of those places that you talked about because that's just not what we do. Like you cannot afford, if you only have $100. You cannot afford.
This is a metaphorical $100, Tom.
Question, right?
It's not like you have $100 to your name and Tom's telling you you got to save the $100.
Black or red, baby, black or red. What do you feel?
That's not what I was saying. What I'm saying is you have to go to the deepest pool of liquidity. That's all it is. So it's irrelevant. Like, you're not going to emerging markets. You're not going to China. You're not going to Europe. You're going to the deepest pool of liquidity. So you're going something here. So if it's Coinbase, so be it. I don't care. But you're not going somewhere else.
Fair enough. I think I put it on emerging markets. I think I'm betting on emerging markets 2023.
You're so full of crap. There's nobody's betting on emerging markets.
I do it through U.S. liquidity. It's not like I'm going over to, you know what I mean, to open up an account on a foreign exchange. That's not what I'm trying to do.
I know what you're saying, but nobody bets on emerging markets. I mean, that's the crappiest. That's the crappiest bet in the world. That's like,
clip this. I want somebody to clip this and just remind me of it in 12 months. December 6th of 2023, I want to have this conversation with you. And if I'm lucky, emerging markets are the outperformer of the entire year.
Do you want to know something? One of the biggest scams ever perpetuated on the ETF industry was emerging markets. Because they're illiquid, they're crap, they never go anywhere, there's no pool of liquidity at the end. It's just
It's an easy sale.
It's an easy sale because it sounds good on paper. Emerging markets is garbage.
Right. You want these Kazakhstan bonds for sure.
Yeah.
Fair enough, gents.
Thank you, my friend.
Thank you, Mr. Jones.
Appreciate your time. We're going to take a quick 90-second break and come back. We got a market measure next. Tasty Live.